Most people believe financial collapse is obvious. They imagine panic, screaming headlines, and sudden chaos that forces everyone to react at the same time. But history shows something very different. Collapse is quiet. It feels normal. It blends into everyday life. And by the time it becomes undeniable, your money is already trapped inside a system that no longer works the way you expect or the way it promised to. Collapse doesn't punish recklessness first. It punishes trust. Financial collapse is rarely a single event. It doesn't arrive as a dramatic break between before and after. There is no universal day when everything suddenly stops or resets. Instead, collapse unfolds gradually through small adjustments that seem reasonable at the time. Policies are introduced as temporary. Restrictions are framed as necessary safeguards. Exceptional measures become routine, then permanent. Each step feels manageable on its own, even sensible. Life continues. People still go to work. Stores still open. Markets still function, at least on the surface. Screens still show prices, balances, and reassurances. And because daily life continues, most people assume the system itself is still intact. That assumption is the most dangerous part. Human beings are remarkably adaptable. We normalize discomfort. We rationalize decline. We adjust expectations downward without fully realizing we're doing it. When prices rise, people cut back just a little. When purchasing power falls, they delay plans instead of abandoning them. When access becomes harder, they assume it will return in time. Collapse relies on this psychological flexibility. As long as people believe conditions are temporary, they don't change behavior in meaningful or protective ways. They adapt, explain, and wait. Waiting becomes a habit. By the time belief shifts from temporary to permanent, most real options have already closed. Every collapse is explained emotionally. Leaders blame crises. The media blames shocks. Experts blame unforeseen events and bad timing. But collapse itself is structural. It begins when promises grow faster than production. When obligations expand faster than capacity. From childhood, we are taught that money stores effort. You work today. You save that effort. You redeem it later. This lesson feels intuitive, responsible, even moral. It rewards patience and discipline. But it only works if the system issuing the money remains stable over time. History shows that stability is temporary. In Weimar Germany, disciplined savers lost everything. In Zimbabwe, pensions became meaningless numbers on paper. In Lebanon, balances still exist, but access does not. Money rarely disappears outright. Instead, it loses its ability to perform its function. It still exists nominally, but not practically. Money is not wealth. It is permission to access wealth. When that permission is revoked, restricted, or diluted, stored effort vanishes, quietly and legally. One of the most confusing aspects of collapse is that numbers remain visible. Account balances still show. Prices are still quoted. Markets still appear to function. This creates a powerful false sense of safety. People feel wealthy on paper while becoming poorer in reality. They trust what they can see, even as what they can do steadily shrinks. Collapse does not destroy numbers. It disconnects them from usefulness. A large balance that cannot be accessed, converted, or spent has no functional value. Visibility without utility is one of the cruelest illusions of modern collapse. Across history, one distinction always holds. What is real survives. What is abstract fails. Land continues producing food. Buildings continue offering shelter. Tools continue enabling work. Paper claims require enforcement. They depend on courts, contracts, and institutions. Collapse weakens enforcement long before it destroys production. When enforcement weakens, claims dissolve. This is why collapse does not end civilization. It ends representations of value. The real economy continues beneath the financial one. Modern societies trust prices. We believe markets reflect truth. We assume price signals reality. During collapse, prices lie. In Venezuela, stock markets rose dramatically while living standards collapsed. In hyperinflation, rising prices signal currency failure, not prosperity. Price measures distortion. Value measures usefulness. A productive asset retains value even if markets close. A speculative asset collapses without liquidity. Collapse does not eliminate needs. It eliminates confidence. Speculation depends on belief. It requires optimism about the future. It requires participants willing to take risk. It requires buyers tomorrow who believe conditions will improve or at least remain stable. Collapse destroys belief before anything else. Liquidity disappears. Participation falls. Confidence evaporates long before systems officially break. Speculative assets fail not because they are immoral or flawed, but because they require trust and continuity. They assume functioning markets, enforceable claims, and a future that resembles the present. Production does not make those assumptions. Food must still be grown. Energy must still be produced. Shelter must still be maintained. Essential work continues regardless of sentiment or price signals. This is why productive activity outlives speculation in every crisis. When belief fades, speculation ends. When belief fades, production adapts and survives. Collapse doesn't announce itself through loss. It announces itself through friction. Things become harder, slower, and more conditional. Access requires permission. Movement requires explanation. Transfers require justification. What once worked automatically now requires approval. At first, these changes feel administrative. Forms replace freedom. Delays replace immediacy. Limits replace choice. Nothing feels stolen, only regulated. This is how systems extract value without confrontation. They don't take everything. They ration it. They introduce thresholds, caps, windows, and rules. Each rule feels small. Together, they change the nature of ownership. Ownership during stability feels absolute. Ownership during collapse becomes conditional. You still own your money, your assets, your income, as long as you use them the right way, at the right time, for the right purpose. This is why collapse rarely produces resistance at first. People argue about inconvenience instead of loss. They negotiate around restrictions instead of challenging them. They adapt to rules that would have been unthinkable years earlier. Collapse advances through compliance. The financial system begins to prioritize control over function. Liquidity becomes dangerous. Capital movement becomes suspicious. Saving becomes destabilizing. Spending becomes encouraged selectively. The system cannot allow everyone to act independently at once. So it restricts choice while preserving the appearance of freedom. Money flows, but only in approved directions. Markets operate, but only within boundaries. You can participate, but you cannot exit. This is when trust quietly reverses. People stop trusting institutions to protect them. Institutions stop trusting people to act responsibly. Every safeguard is built on this mutual suspicion. Every restriction assumes misuse. Every exception proves the rule. What collapses first is not currency, but consent. People continue participating not because they believe, but because alternatives feel unclear or dangerous. They stay because exit feels risky, unfamiliar, or socially costly. And as long as participation continues, the system appears stable. Collapse thrives on this hesitation. Another illusion takes hold: diversification. People spread assets across accounts, platforms, jurisdictions, and instruments. They feel protected by complexity. But complexity is a feature of stability, not stress. During collapse, complexity becomes fragility. Systems fail along shared dependencies. Payment rails close together. Markets freeze together. Access rules synchronize. What looks diversified on paper behaves identically under pressure. This is why financial sophistication offers limited protection. Optimization assumes normal conditions. Collapse breaks correlations. Rules change mid-game. Historical models fail when incentives flip. The system doesn't need to confiscate wealth. It only needs to make it unusable at the wrong moment. Timing becomes everything, and timing is controlled. Collapse rewards proximity to reality. Distance becomes a risk. The further value is from direct use. The more layers it depends on, the more vulnerable it becomes. Abstract wealth depends on uninterrupted systems. Real wealth depends on continuity of function. By the time people realize the difference, they are already on the wrong side of it. And this is where collapse transitions from quiet to permanent. Not through panic, but through structure. Debt amplifies outcomes. In stable systems, it accelerates growth. In unstable systems, it accelerates failure. Debt assumes predictability. It assumes stable income, reliable demand, and manageable volatility. Collapse removes predictability. Income becomes volatile. Demand contracts. Costs remain fixed or rise. This is why foreclosures surge during every financial crisis. Not because people suddenly become irresponsible or careless, but because leverage stops working when volatility explodes and margins disappear. Many people defend debt as productive or strategic. Under normal conditions, it can be. But collapse does not care about intention. Mortgages assume stable income. Business loans assume predictable demand. Education debt assumes opportunity and upward mobility. Collapse breaks assumptions. Income falls. Demand shrinks. Opportunity narrows. People without debt struggle. People with debt are erased. This pattern appears without exception. It is not ideology. It is arithmetic. History consistently rewards capability over capital. Assets can be seized. Money can be inflated. Accounts can be frozen, restricted, or rendered inaccessible overnight. Ownership exists only as long as enforcement exists. When enforcement weakens, claims dissolve. Skills remain. They are internal, portable, adaptable. They cannot be confiscated by policy or diluted by decree. A skilled individual can rebuild in almost any environment. They can trade labor for food, shelter, or protection. They can adapt to shortages, improvise solutions, and create value where none appears to exist. This is why refugees with skills recover faster than those with savings alone. Money runs out. Markets close. Access disappears. Capability does not. Systems fail. Capability persists. Modern life teaches reliance on institutions. Banks store savings. Governments provide security. Corporations manage supply chains. Specialization replaces self-sufficiency. Efficiency replaces resilience. This works until it doesn't. Institutions are optimized for stability, not stress. They function smoothly under predictable conditions. Under pressure, they fragment. When institutions weaken, society does not collapse into chaos. It decentralizes. Responsibility shifts downward and outward. Family replaces systems. Community replaces contracts. Reputation replaces credit. Trust replaces enforcement. Informal networks emerge where formal ones fail. Exchange becomes local. Support becomes personal. Survival becomes collaborative. This pattern has repeated for centuries. Across empires, currencies, and governments. Collapse changes structures. It does not change human behavior.